Hello everyone who's joining, and let's wait a few couple minutes for more people to join, and then we will start the AMA session.
Yeah, hello everyone.
Hi there.
Hi Timo.
Hi, Timo here from Swarm.
Yeah, as said, Boris, we wait a couple more minutes and kick it off.
All right, no problem.
Timo, how are you doing today?
Yeah, very good, thanks. Yeah, what about yourself?
Me too. Quite a busy day, but that's probably for the better.
Yeah, I mean, yesterday was an interesting day for sure as well in the U.S. and things are going in a pretty interesting direction.
It's hard to disagree, and if it would be curious to discuss the impact of that SEC decision on security tokens, because obviously the impact is indirect but still existing.
Yeah.
All right, guys, I think we can kick it off. So as we settle in, let's take a moment to welcome all our participants. And today in this Twitter space, we're here to dive into some captivating discussions. Regrettably, Philip had to attend some personal matters and won't be able to join us. Nevertheless, we're honored to have a special guest with us, Timo Lehes, co-founder at Swarm, and also Boris Pikalov, head of analytics at Stobox. Let's start with some brief introduction, folks.
All right. I can kick off. Basically, Timo here is co-founder of Swarm, and we started working with security token issuances in 2018. Basically, built the platform in 2017, and then finalized it in 2018, and then got a bunch of projects that we're working on tokenizing various types of assets. Obviously, the problem was always like once you've tokenized, where are you going to trade these things? And there were really no proper functioning trading venues for secondary liquidity that were actually using the blockchain as a kind of a infrastructure. So there were a couple of centralized exchanges. We were in the US at the time, and we just decided that this is not going to work out under the traditional kind of regulatory regime. So we moved everything to Europe and set up shop in Germany. So now we're regulated by BaFin in Germany, and we can trade on our DEX and the decentralized OTC contract. We're trading both crypto and digitized securities.
Okay, super. And our journey is similar in some extents. We started a bit later. Our journey has started in late 2018, and it's curious because we've been quite outsiders to the markets. None of us are from, none of the initial founders are from the countries with developed capital markets like US and UK. So we come, and none of us are strongly from a financial industry, coming primarily from a tech background. And this led to this very engineering view on the industry. How can we find a way to hack it while still staying within bounds of law and fitting into the traditional needs of the industry? So we also designed a tokenization project and onboarded a bunch of projects, and we also see the liquidity as primary issue, though our focus isn't on creating a single DEX where all our clients would be traded in a single space. Instead, we want each of our clients to have almost like their own private exchange with their space where their investors would trade, but at the same time having a shared space where investors between the project would exchange each other. And we also focus more on decentralized trading rather centralized from the perspective of reducing regulatory requirements for our customers.
Awesome, guys. Thanks for these introductions. And now let's kick things off with our first topic. What are the current?
No, that's great, Boris. I think actually, we have a pretty similar model in that sense because we also offer something that's called market as a service, which is basically a white label offering of the regulated DEX. So I think it's not like completely the same, but it's quite similar from that point of view that if somebody wants to run a music rights exchange, then we can enable them to do that, and that's like on a white label basis, and it's separated from what's happening on some of the other verticals, such as like tokenized stocks and bonds, which is then operated directly by us.
Yeah, that makes sense. What I have found is that there are a few players who target a specific niche or specific industry, real estate obviously being the most popular, but essentially from a technology perspective, tokenizing or creating liquidity for different types of assets is the same, because the token kind of abstracts the nuances related to a specific industry and focuses on aspects about corporate finance in general, which is the same for all kinds of industries. And from this perspective, obviously it makes sense to have the same technology being a backbone for different kinds of industries. At the same time, mixing different assets on a single marketplace or a single exchange might make sense for some business models, but doesn't for many others. Especially given, I'd say one of the focuses of tokenization is to enable investors access to new asset classes they previously didn't know existed or weren't investable. And from this perspective, as a business launching in such kind of niche, you want to focus specifically on promoting this specific asset class, being music rights or IPs or art or anything else, and it would make sense to have a segregated marketplace which might have the same backbone, but focus only one type of tokens.
Yeah. And I mean, we were gonna go through a couple of questions here, or like who's gonna run that? Just in terms of like the talking points.
Yeah, because I have actually a list of the token points we arranged previously, so I can go through them. Or also,
Perfect.
Okay, so basically most of them discuss to where we are currently in the market and what are the primary challenges and what we need to enter into the next stage where we actually go to the inflection point and change the market. And as we were also curious to discuss liquidity. So initially, I would start with topic number one, which is where are we currently in the tokenization market? What issues have been solved and which still exist?
Yeah, I mean, from our point of view, I think on the regulatory side, quite a few things have actually been solved now. So there's a number of places where you can run now like a digitized securities exchange under a regulatory model, and I think like that's provided quite a lot of clarity compared to for like 3 to 5 years ago. So I think that's a kind of a positive development, like especially if you're dealing with digitized securities, which are obviously securities, right? So you don't have the issue of identifying whether something is a utility or not a security, or whether it's a security. So the German banking legislation basically said, if it's a digitized asset, it's a financial instrument, and if you're going to trade it or hold custody, then you need a license. So I think that's provided a lot of clarity. On the issue side, I mean, we're still looking at very fragmented liquidity. So it's like, for like when we discuss whether a marketplace should be, let's say, an aggregation of multiple different asset types, or whether it should be, like a distinct marketplace for one particular type of asset, then of course, a lot of that consideration comes down to like, okay, so is there sufficient liquidity to actually make the market work? And what do you do before you actually have, let's say, a AMM pool, or like a DEX structure that has sufficient liquidity to create like reasonable slippage and volume and so forth. So I think those are the things that are still outstanding to many degrees, and it's like something that we're working on all the time with our customers to kind of figure out like who already has a large user base with a lot of volume, and how can we just kind of plug in alternative assets that are digitized into that volume, so that it doesn't become like something that we're building always from scratch, because we know that that takes forever.
These are very good points, and I resonate with many of them. On regulation, the things have definitely become easier. Though myself, I don't feel like the issue with regulation is fully solved. And there are at least two aspects of that our customers still aren't fully comfortable with. One is the issue of corporate law and recording about transactions, specifically regarding transactions with change share register. Because in many countries, and this is especially the case in Europe, this isn't a problem in US, for example, when you transact in equity securities, whether tokenized or not, you need to report the transaction to a share register, the registrar. And doing this for every transaction kind of undermines the idea of liquidity by increasing transaction fees and limiting the number of transactions you can do. So this is quite inconvenient unless you become a public company, which isn't really feasible for many of our customers. So this obviously limits the number of jurisdictions which can be employed, which isn't a problem per se. So it's not a problem for, let's say, Maltese company to set up a German entity or Liechtenstein based. However, it does lead to an increase in cost. It makes the process longer because you need to set up a new entity instead of using existing one they used to run a business. So there is still some inconvenience in terms of corporate law and choosing the jurisdiction. I don't know how it is for you. For us, we have customers from all around the globe, like all 5 continents, and sometimes these are countries which, because of not having that active capital markets, also don't have that well-tailored legislation, such as Cambodia or Philippines or Kenya or Egypt, and they do need foreign SPVs. So this is one of the issues we are facing. Another aspect of the regulatory issue is also some lack of clarity regarding application of prospectus exemptions when you are targeting multiple jurisdictions. Like even in EU, if you're using let's say €5 million exemption that is doing a sale under but limited to €5 million in the EU, there are different filing requirements in different countries, and these limits can be different in some EU jurisdictions, which introduces some degree of inconvenience and risk for investors. And this becomes especially complex when how do you correctly include UK and Switzerland, each of which have another 8 million limit, and especially when you expand to further countries. So to some extent, it's just a technical issue of tracking these limits in each jurisdiction, which obviously can be solved by just right kind of on-chain validation we are creating. But it's also the issue of issuers being concerned about legal risk being created, and thus thus cautious about moving forward or just spending more time in due diligence and getting sidetracked. So just from this operational perspective, we see some issues. So I would say, but this is also the issues that I don't see being resolved in the near time, because it requires quite a significant cross-border collaboration in establishing common standards. And I believe this would happen only when we get to really significant volume of companies using that kind of regulatory arbitrage to dodge prospectus requirements. When we get to that point, then regulators will recognize the need to collaborate and establish a common framework. But I believe we are many, many years until that. So before that, some degree of uncertainty will still prevail. And that might not necessarily be bad, because we're still getting a potential chance to raise significant amount, like up to $20 million, by combining different kinds of exemptions. So this isn't as bad, actually, because of opportunities it provides to issuers, though it becomes even a bit more confusing on the secondary market, of course.
Yeah. No, it's a good point. I think those are excellent points. And what you end up doing is basically, I mean, at least the way we approach it is like, of course, within the European Union, we focus mostly on secondary liquidity more than primary issuance. So I agree with you. The primary issuance is really a patchwork, and then you have to register here and there to get something done. On the secondary liquidity, it's a little bit different, because we're actually able to serve, basically the European. So effectively, BaFin, that regulates our activities, are basically saying on a reverse solicitation basis, we're able to serve whichever country that meets certain criteria for onboarding, for with regards to KYC and not being on sanctions list and things like that. And then we have decided to actually exclude the US and Canada right now, because we don't have a license structure that allows us to basically support users from there. So if we were to trade, allow US users to trade on our securities that have been issued on Swarm, we think that it would only be a matter of time before, the SEC would basically say, hey, you don't have an ATS license, you can't trade, you can't serve US persons for that. So we've focused on like non-US, non-Canada, which I mean, still like, obviously massive markets everywhere. And but you're right, like even within Switzerland and UK and some other places such as Singapore, I mean, they're really important like capital markets, and in the end we will branch out and expand our regulatory footprint, because it's a necessity to build out the business as well, and to be able to have the freedom to kind of offer all the kind of different services and products that we want to offer. So it's not really enough to be like, have like one jurisdiction that's like your anchor point, but over time you kind of have to expand out, and we've seen that with all the big financial services firms that have been developed over the years in TradFi, that they end up having a bunch of licenses here and there, and we've seen that in crypto already as well. So I think it's not nothing like new. It's just that it's how you solve the fact that you mentioned, that basically there's no basically standardized regulatory framework that works globally. It's not even close to it, so it is what it is. So we have to work around it. And on a technical level, the way we're approaching that is basically to say each of the issuers, and I agree with you, the issuers are very concerned with like where their tokens are going to end up and who will be able to buy them and trade them and do whatever, because like you mentioned, it does provide some legal exposure on their part. So it's super important for them to be able to know that their provider is basically able to kind of manage those different aspects, so that we basically drop NFTs it could be down to on a per asset basis, to basically decide like each of the wallets that have a particular type of soulbound NFT in the wallet after onboarding is allowed to trade this particular asset. So we can do that down to per issuer level or per asset level or like per country level, or, whatever, right? And so as a wallet and user, you basically have like potentially multiple NFTs representing different rights to trade various types of assets. So that's how we kind of built a technical solution that addresses, the complexity of all these multi-dimensional Rubik's cube that you have to solve to be compliant everywhere, but still, serve a lot of different jurisdictions and users and issuers from various places.
That's a cool realization, and we are having something similar, and this touches also to the topic of existing barriers and the topic of liquidity, because one point that we see in terms of adoption is just the capacity of issuers to raise capital. Most of the companies who are coming to us are new to the crowdfunding fundraising game. Previously, they worked only with banks or only using proprietary capital. So this is a completely new game with them, and they somewhat struggle with the investor acquisition. And so building a community and distribution channels is one of the factors in making it even more comfortable for companies, ensuring that they do eventually come to the secondary market, and that by their success they create the signals that attracts new companies, and we get this virtuous cycle of more and more companies coming into the tokenization space. Investor acquisition is one of the key issues we focus on, and this ties into the topic of identity you mentioned previously, because the way we solve identity is, instead of having, and we also use soulbound tokens, but instead of having a separate soulbound token for each issuer and in relation to each asset, we use a single or a small set of soulbound tokens for any investor, which can be, for example, a different soulbound token for an accredited and non-accredited investor, and in the private data of the token, it also has information about the jurisdiction that can be read by the issuer. And what it allows, that for issuers who opt into this ecosystem option, all investors whom they bring would now be part of the common ecosystem and now can go to other issuers. So they are bringing investors who become part of this shared pool of investors who now can support other projects who would come to us, and thus facilitate the fundraising for them. This is a bit different route from the one you took, because you mentioned that your focus is more on going to existing institutions that do already have access to capital, access to investors, and you don't have to reinvent the wheel by going to them.
Yeah.
With us, this is
Yeah, I think it's partially because we're focused much more on secondary liquidity than primary issuance. So I think it's because some of the customers that we have basically want to use our, the tokenized assets the real world assets that we have issued. So that's a very particular segment, because they want to use tokenized stocks and bonds like Apple, Tesla, Microsoft, etc., as part of their offering. So we basically build like a wholesale API into them, so they can provide, basically OTC orders directly into our infrastructure, and then they can offer that to their users. So that's like one way of bringing those products to market, and then we just become like a back-end trading venue that's regulated, and that allows us to offer up these securities to them. So that's quite a different model from doing like primary issuance to a set of investors for a particular type of company, and then after that you will be trading that. So I think it's, I mean, on one hand, there's a lot of demand. Like we saw that already when FTX was doing the Apple and Tesla stock trading and all that stuff, and they were doing that through a company in Germany that I think Alameda ended up acquiring eventually, and then it got rolled up in that whole mess. But there was like, what was interesting about that was that there was actually it wasn't like huge volume, but it was actually quite strong volume. And Bittrex had the same product, and they were also trading stocks on the centralized exchange. And so we kind of saw like early indications that some of the crypto users were actually pretty interested in trading traditional stocks as well. And especially when you don't have to sign up for a traditional brokerage application, you can just kind of mix and match your crypto with securities, and stocks and bonds. I think that was kind of a proof point for a successful model. So now, because FTX kind of went away, now it's being kind of reinvented again in different shape and form. So that's kind of bringing the RWAs into a space where anyone can trade them from their crypto exchange or crypto application. So that's happening. That's a given. And then we have all these other kind of white label customers that want to build marketplaces for carbon markets or for like music rights or whatever kind of assets that they're managing, which is kind of a different type of segment. And there I would say it's a little bit, it takes a bit more effort to acquire new users, because although they already have like a bunch of investors in most of those asset classes, you still need to kind of educate them on this new way of buying, and some of them are not used to crypto, and even if you provide like a hosted wallet, it's still a little bit of a hurdle for them to get in, right? So I think in terms of really getting to a mass market, it's like everything needs to be kind of integrated into a very easy to use application, right? So that the fiat onboarding is there, the crypto is there, the stocks is there, like all the different tokenized assets are there, and that's kind of how you get to volume on the retail side.
Oh yeah, that's definitely one of the points I wanted to touch upon. That when we speak about the issues and barriers to mass adoption, user experience is definitely one among them. And as we see, especially among the users who are not sophisticated, who used to invest through their personal relationships with brokers whom they did call, crypto is something entirely different from them. For them, and these are primarily the old folk, and who ironically have the biggest amount of wealth in the world is concentrated in that generation. So if we want this mass adoption to happen, this is the kind of audience we need to cater to, and this means somewhat letting go of our technology maximalism and embracing some of the old ways in which marketing has been done, and it also includes simplifying the user experience. So this is, I would say, previously it has been challenging to some extent because of the technology limitation, but in the last few years, especially with the emergence of account abstraction, I believe we would see more opportunities and better experiences. But here we run into another issue of fragmentation and just being overwhelmed by sheer amount of opportunities. There's been now all this new stuff existing in real estate, but also IP and music and art and rare cars and collectibles and private equity of companies around there, and this. And now the diversity of assets that can be included in one portfolio is so big, and all of them are in different platforms. So you also need to have now dozen accounts in different platforms. And this, I believe, would be the next milestone from the perspective of user experience. Now, when we created all of that diversity, how do we scale it back and make it comfortable again for investors? So I believe in the next few years, we would still be in the point of increasing diversity and not increasing. So I feel there are not that many people, except for the most progressive of us, who do feel this paradox of choice. It will be instead, so our focus now is less on how do you incorporate all those different asset classes in your portfolio. Currently, education efforts is, hey, you know that your portfolio can include something more than just stocks and bonds, and here are all the different curious things that you can do. But at some point, we will run into this saturation, and this is where we would have, where I believe there would be either a wave of acquisitions, just companies buying each other's, because competition will erode margins, and there has to be some degree of consolidation, or there will be a second layer of aggregation apps, or there will be AI recommendation algorithm. I'm not yet sure how will AI play into that, but there definitely will be another layer of helping investors, especially the ones who don't have that much time to create their portfolios, to navigate this diversity.
Yeah, those are really good points, and I think, I mean, but I mean, there's already a bunch of applications that have like some kind of financial focus out there that have 50 million users, 100 million users. Now, X.com might become a financial application, and there's like, I don't know, 350 million users or whatever it is, and so we're already seeing that there are already these like user bases out there, and I think the question is like, how do you build like a really good product that meets that those audiences that are already out there on one hand, which is one very particular type of business model, and then the other one is actually to become maybe a bit more innovative than they are willing to be, to basically say, like you said, let's bundle together 5, 6, 7 different asset types and put them all into a single application, and then we issue a MasterCard against that application, and then we allow people to borrow against those assets, and then we have like all of a sudden we created this like new way of using digitized assets as your investment product, but also as like a flexible way to borrow money and stuff like that. So I think there are many ways that can be built, like new products that are not even like that, where the incumbent kind of user bases are not even close to having that in market. And so there is opportunity to build those innovative products, and then of course, like you say, there will be an M&A play and like a roll up eventually, where all the big, because it costs like several $100 million to build a user base like that, and you need a really good product on top of that as well. So a lot of those companies have a lot of resource, and therefore they will probably buy up a lot of the people that are building the more innovative product on the blockchain side of things.
And I feel like part of this synergy can exist with saving apps and the payment apps, because currently they're more of a front end which users use to manage their money. And when you choose to invest, it's just easier to do if you do it directly from your payment app, where you can set as for example, a set sum that would go each month to your investment account or something like that. So this seems to me like what would end up being a single interface for financial needs, whereas investment apps being integrated into either neobanks or existing payment apps, and maybe this will be other way around. Maybe it will be us players in the tokenization space buying payment apps and making a single convenient solution. So I'm not sure who will be acquiring whom, but this seems to me like a natural way to decrease the complexity for the user, for them to see like, here is not just your investment portfolio and how it is allocated. Here is how your investment portfolio relates to your overall budget. Like this month you spent 30% on food, 50% on rent, 10% on entertainment, and 10% has been invested. And this also allows for an integration with various kinds of loyalty programs or cashbacks or rewards, which can go into investments, and vice versa. The amount of your investments impacting your credit score and how much you can borrow, and directly impacting your credit card limit, because this credit card is integrated with your brokerage account. So there seems to be a lot of possibility there. I would say one problem that we should be careful about is antitrust, so that there isn't too much control over our financial lives and too much integration. Currently, there seems to be a pretty good competition in the financial industry, but you never know. So this is something where I would be potentially concerned.
Yeah, no, it's a good point. And because it's so expensive to build those user bases, there will be, yes, probably multiple companies, but only probably a few of them at the top. So even on a pan-European level or maybe even global level, I don't know. Potentially, people will come up with something else in Asia, which they've already have in parts of Asia or Southeast Asia, as well as in South America. So I think they're but yeah, and then of course, the other thing that we're seeing is that the more sophisticated institutional investors, they're looking for completely different things. So they're looking more for okay, so once we are on chain, then can we combine traditional products, like let's say a treasury bond, maybe with some option strategy overlaid, and digitize that, and then put that into the same mix together with other products from the crypto space, and then build really unique strategies around the different types of assets. So basically, you're moving between crypto and treasury bonds in a creative way, and then kind of rebalancing that and building really clever strategies. I think we're seeing that there's quite a lot of interest in that space, and obviously DeFi then becomes a critical component of that, because there's so many different creative models where you can build various types of strategies using DeFi and smart contracts. So I think there's a lot of stuff that needs to be developed there as well. And I mean, the part that we're addressing there now is just bringing some of the TradFi assets on chain so that they can be easily integrated into kind of various on-chain strategies. Because if they're sitting somewhere in a brokerage account and you can't really access them from your digital strategy, then it's a huge limitation, right? So that's why we keep expanding this portfolio of stocks and bonds that we're issuing ourselves, because we're seeing that there's a demand for that, going forward.
Yeah, this is such a good point. And I believe one of the selling points that has to be used when pitching tokenization and working with crypto and tokenized assets to institutional investors is the added yield and the more interesting strategies they can do while using DeFi. And when it comes to individual investors, to crypto adopters, they make very significant amounts of money on playing with DeFi, on decentralized generation. So it should be expected for institutions to play such games as well, especially when a larger percentage of economy becomes tokenized. Though it would also be interesting to see how, when everything happens on chain and you have higher degree of transparency, it's easier to copy someone's strategy, because you can see, or you can set up a monitoring systems to find the wallets or the systems that have higher degree of the highest profit, and then try to copy and mimic or reverse engineer their strategies. So we are also going to see more cat and mouse games, where companies and advanced traders are trying to hide their place by using different wallets or anonymized chains or cross-chain approaches, and others are trying to find them, reverse engineer, and earn yield in this way.
Yeah, absolutely. And I talked to a couple of people that are building proprietary strategies and running a hedge fund type operations, and they're obviously one of the if you charge a 2% management fee, and then you have some kind of carry model on top of that, eventually, if people actually figure out what you're doing and how you're doing it, then like you say, based on analysis of what's going on chain, and they believe that they actually have the the capacity to replicate that, then of course people will basically do it themselves if it's possible eventually, or just from a competitive standpoint, like you say, it actually becomes a real issue because you can start reverse engineering what's actually going on across those different strategies. So I think that's it's obviously, and the other thing that we've seen is obviously institutional kind of fund managers, and particularly when you're managing a hedge fund, crypto hedge fund, let's say. I mean, you don't want to disclose which wallets are yours and what you're exactly doing right now, not even on the long hold level, because you kind of want to maintain that as your proprietary data. And so I think a lot of that needs to be solved as well, in terms of how and then of course, while having that anonymity, if you will, in terms of which wallet belongs to whom, at least from an external point of view, then that kind of goes in contrast with having the maximum liquidity across what you're trying to do. And most of the time you'll find that on Ethereum or Arbitrum or Polygon or something like that. So yeah, those are still I think big items to be solved. And then on top of that is this whole like we've seen like yesterday in the US now with GBTC, right? Like if it becomes okay for an institutional investor to buy a Bitcoin ETF, then all of a sudden that's a huge shift, right? Compared to before, when everybody was like uncertain whether it would still be okay to buy a Bitcoin ETF or not. Well, first of all, they didn't exist in the US, but even buying products like, managed Bitcoin, managed Bitcoin financial products and so forth. And now that that's been like clear that it's probably okay, and they might even approve, an ETF sooner or later here in the coming months. Well, then all of a sudden the regulatory hurdle is gone as well, at least from an investor point of view, and then that's a huge barrier as well.
I agree with that, and we are going to see. I'm not sure if we are going to see that degree of appreciation in BTC price as we've seen in the last decade, because already very significant volume has been observed. However, more products being built on top of Bitcoin and more access of institutional investors is one of the factors that can still prompt at least one another strong bull cycle and one another round of very good returns. On the previous point regarding privacy on chain, it's curious how this also refers to individual investors for whom wallet becomes another very sensitive item of personal information, because previously, even if your name, email, and other data has been leaked, you would still preserve quite a significant degree of privacy. If your wallet address or addresses are leaked, then not only your current wealth is being known, but also as all your basically your history of transactions. And there is and now companies can use this data to pitch you further products. Now this can be used by just all kinds of financial scammers or just people whom you don't want to know about your personal details. So privacy of wallets and transactions does become to some extent an issue. And when I think about evolution of blockchain and zero knowledge proofs, I believe we are going to see somewhat higher degree of transaction privacy, and we still need to find this right balance. When on one hand we want to have high degree of transparency and auditability, so that so that everyone controls everybody, and we can have a fully trustless environment. But on the other hand, the one that would preserve everyone's sensitive information.
Yeah, exactly. And we'll see where that goes. I think zero knowledge proofs, and then also like the whole kind of account abstraction space, and then we'll see. I mean, obviously omnibus wallets are they are what they are, and then people kind of know which exchanges they normally belong to, but then there's a bunch of stuff going on behind there that you have really no idea exactly what's happening on the transaction level. So I think there's like many things to kind of address here, but I think actually the privacy issue, it's almost like the market is really pushing towards KYC wallets and everything else to be known, but it should only be known like when it's actually needed to be known, and not known always, and that's not by everyone for sure. So it's like it's something that needs to be solved in a much better way than it is today, and so I think that's coming.
Can't agree more. And moving on to other point, one thing that I believe deserves further discussion is liquidity and how to create it. Because it's probably easier with public company stocks, with private company shares being traded because of the very limited market cap and still limited adoption. It might be challenging for many of them to create liquidity and sufficient trading volume to execute the promise of easy exit for their customers. So we wonder, what are your approaches to incentivizing trading and creating sufficient liquidity?
Yeah, we thought about that quite a lot, and I think on the early issuances that we worked on in 2018, 19, and so forth, I mean, you saw that it was actually really difficult to kind of acquire investors and build liquidity around digital securities. And so when we looked at like how to approach it now on our secondary liquidity venue, we actually decided to build our the primary issuance piece that we've done with the public stocks and bonds. We decided to choose assets that, because like digitized securities is still kind of a fairly novel concept. So then the reason that we chose those particular names and financial instruments was because if one aspect is new, i.e. you're holding an asset on blockchain and you're buying it maybe with crypto, then the other part of that equation, which is the asset that you're buying, if that is a well-known asset, then there's less to explain, and there's like, it's easier to build liquidity with something that's well understood compared to something that's like a very complicated fund strategy, or like you say, a private company that has maybe a lower market cap and so forth. So I think that's why we chose these, like, that started with like Apple and Tesla. Like, the Apple's market cap was bigger than the whole crypto market cap when we launched this product. And basically then we added the treasury bonds because we saw that was needed on the stablecoin side, as well as for some of the trading strategies where people just wanted to have a yield from treasury bonds instead of from AVE and compound, because those rates were not attractive enough. So we just took like very well-known products from the traditional financial markets, and then we said there's massive liquidity for these products off-chain, and then let's use them as a vehicle to build liquidity on-chain because they're so well understood and everybody knows what it is. So that's like removing a lot of the obstacles of having to explain, like, oh yeah, here's a wallet, and oh yeah, here's the security. What security? Well, it's this kind of security. And then it's like, well, okay, so does it pay a dividend? Does it do this? What's the how does it increase in value? And if you end up having to explain all of those things to people because they are new, then it's much more difficult to build liquidity around a model like that. So
yeah, that's a very pragmatic and sound approach, and I guess it's already paying out for you in terms of observed volumes.
Yeah, so it's where we're basically seeing it is on the wholesale side. So not so much on people are kicking the tires. They think it's interesting. They think it's fun to buy Apple on chain and not having to go into the fiat world to buy stocks. They think it's a cool thing. So the volume is like gradually kind of increasing on the retail side. But what's more going to really move the needle is like when we're making a couple of the announcements of the wholesale clients. It takes a little bit longer to integrate with them because it's basically like an API-based service that has to be built into their product, and then everything has to be kind of coordinated into a launch. But those things will generate much more volume in the near term, actually, than the direct retail access. But it's important to have direct retail access because, like, it's so difficult today to actually, like, all the talk about real world assets is actually very few people that are buying any real world assets on chain. And there's very few places where you can trade them. So that's why we thought it was important to provide direct access for retail, because that's how you learn about this stuff. And then we even have like a bunch of partners and investors and so on that have just registered on Swarm to kick the tires and understand, like, how does this actually work. And then once they see it works, like, you just use your Ledger or MetaMask or institutional custody, and then you buy your Apple tokens, and then they sit there in your wallet. I mean, it's a pretty cool thing, and so it's kind of a way to educate the market as well.
That's a cool stuff. The way we do it, and we see two key aspects that are needed to create liquidity for tokenized small and medium enterprises. The first is market making. So it is objectively the case that you would expect more rare transactions and less people willing to buy and sell at all times with companies who might have a market cap of just a few $1 million. So in this instance, it might be the case that you just wouldn't have a counterparty who would be willing to trade today, but someone might appear in a week or two, let's say. And in order to deliver a proper trading experience, you need to have an intermediary who would step within the transaction, and this is where having a decentralized market making protocol, it can be an issuer, it can be a third party, but someone who would deliver this better experience is a critical aspect of making it meaningful for investors. So this is point number one. Second, in terms of who is going to trade, we believe it's vital that issuers primarily engage their customers and communities, suppliers, stakeholders, because when it comes to Apple, even if you have nothing to do with Apple in terms of engaging with their products, it's still worth spending your time on looking into them, exploring them, because it's a good established company, and you would likely make good returns trading with them. When you have such a wide potential choice of private companies, and when the risk is potentially higher, probably the only advantage you can have is this personal relationship with investor who is trading, and you establish this personal relationship through them knowing you because of how you do business, because you have a great product that they enjoy, or you had a great collaboration. So for us, these two aspects are probably the most important, and this is cool from the perspective of the kind of virtuous cycle it is creating, because if you're good at your business, if you are creating delightful experiences and great products and having strong relationships, then you are going to have better liquidity, which reduces your cost of capital and makes it easier to grow by attracting further capital. So there would be flow capital to good companies because of this mechanism. So I actually see it as a good thing.
Yeah. I 100% agree. And like for those retail companies that can basically say, if you have your crypto wallet with your Starbucks shares in there, and then you basically just use your Starbucks shares as collateral to buy stuff with your crypto credit card or debit card, and then you settle it in the aftermath. I think that's like, if you can create that like value and engagement with your user base, it's fantastic. So I think that's it's a really good model for the retail market. And yeah, I agree. I mean, it's a pretty long way for a lot of the brands to actually arrive at, how they can make that happen. So that's kind of why I guess us as infrastructure players are really important pieces of the puzzle there to kind of show the way on how to do that. I think maybe one thing that I didn't mention is that in addition to having like AMM pools on Swarm, we also have a decentralized OTC contract. So for low volume assets, we're basically using the DOTC contract, which means that even an issuer can put up like line items on the order book to say, well, we're willing to sell 1,000 units of this security at a certain price during a certain time frame, and then it just sits there on a smart contract until somebody takes out the order on the other side. And that's like one way of like distributing the securities when the liquidity is quite low and there's not enough like circulating supply to create like healthy AMM pools. So that's like one way we're using that different kind of trading method, which is still decentralized, but then it's just like it fits better for certain types of low volume assets.
And it's actually a good model if you don't have a set fundraising objective or target. You just want to give the possibility to your community, your customers, to invest in you without necessarily having a fixed fundraising target. Then you just have this order available at all times for anybody to buy. And this is why we're interested in B2C companies. You can have, as a restaurant, for example, on the last page or first page of your menu, or let's say when you delivered an order, you can have a QR code that would allow users who sit there, who have been enjoying your food, to also purchase a few of your tokens if you believe they had a great experience. And so instead of having this as a fixed sale where you spend, and this is also good from a perspective of reducing marketing expenses, because one of the frankly, the biggest expense in an offering for a private company, at least, isn't even legal, because they don't go for a prospectus registration or licensing or audit. It's marketing, which can take like between, in good cases, 1%, but in bad cases, up to 10% of the proceeds. So if you can integrate your marketing of your tokens into your existing marketing, that's a very significant reduction in cost.
Yeah. Very true.
Okay, so as we are approaching the end, and we are probably having the last 10 minutes, but it would be good to hear your thoughts on where are we heading in the future? How is the market going to develop in the next 5-10 years in terms of which volumes are we going to see, what are going to be the most attractive assets, who is going to win, who is going to lose, and how will all this evolve?
Well, okay. It's very hard to pick winners. I think Bitcoin is a winner, just having said that. So that's out there. But, blockchain technology will be used as like, the ubiquitous global, infrastructure layer for value transfer. I mean, that's obvious. It's going to happen. So exactly where and how and which categories that, lead and like how crypto as a innovative market kind of leads people into that versus like more traditional kind of tokenized real world assets that finds their path into existing very large user bases, how much that builds, in parallel with the crypto market, the kind of the native crypto market growing. I think that's really hard to say right now, because like in the end, like, a lot of users that are crypto savvy, they would not accept, to have like a traditional brokerage app with like 2 days of settlement time for buying and selling a security. It's completely ridiculous, like, as it doesn't make sense to that user. So I think, gradually we will see on the retail side that, people will basically move quite quickly over to something like, let's call it like a Coinbase type application, and then go from there to basically integrate everything in one place, including connecting to DeFi, which they already, have an early solution for. So I think that's where a lot of the critical mass will be built, I think, on the retail side. And then on the institutional side, well, if all the institutions globally all of a sudden think it's a good idea to buy Bitcoin and Ethereum, and then once they buy Bitcoin and Ethereum, then they have to start thinking about what to buy next, then that's also going to generate a lot of like institutional inflow, I think. And whether that more tilts towards Bitcoin because it has certain characteristics, or if it tilts more towards what I would call like the financial innovation that's happening across various types of blockchains. I mean, I don't know. I mean, I just know that like when the big money rolls in, it builds pretty quickly. And maybe the financial innovation takes longer time because it actually is quite complicated, as we already talked about, with regards to geographic rollout and regulatory compliance across various geographies, and having to work around the non-standardized regulatory environments, which creates a lot of friction for companies that want to be global, such as us. And so we have to kind of figure out the plan on where we can make the most progress in the near term, and then also have like a long-term plan to cover the most important markets, including the US.
That's a great point, and I agree that we are currently at the stage of complexity where it's really hard to say who the winners are going to be and in which order everything will go. One point that I'm definitely the most excited about is private markets. That's why we're working there, because of the inefficiencies it can solve. Because the fact that that private markets are illiquid leads to less capital going there, and therefore being more stacked in the public markets, where it doesn't necessarily can generate higher returns. So more capital going to private markets is about encouraging entrepreneurship, is to some extent about decreasing inequality because of because of more diverse distribution of capital, is about having a more dynamic and innovative economy. So I'm really excited about this stuff. And to me, even if it isn't the biggest use case of crypto, even if we will see more going to tokenized public company stocks or into Bitcoin and financial innovations, at least somewhat relocating capital flows and getting some of that into private markets, and getting also more efficient pricing in private markets, so the best companies there have better opportunities. This is where, from the perspective of creating social value, I see one of the biggest potentials.
Yeah, definitely. Especially for the company categories that you mentioned, where basically the users are already aware of the brand of those companies, right? So it's not like something that you have to explain from the beginning, but they understand the products, and they might still be private companies, but they would definitely have an appetite for buying those, right? So, yeah, no, that's a good point. And so I think, we're all in this kind of building phase now, and obviously the market has been quite bearish, but as of yesterday, I think we're seeing some positive signs, and I think that positivity on the blockchain side and crypto side will keep building into next year, while still it seems like, the kind of the economic macro environment might be, still quite bearish, with the interest rates and everything being quite high, and it's like it's difficult to move. And so like huge markets that are actually in like have real problems right now. So I think that's going to slow things down. But yeah, I think on the innovation side, I think things will keep moving quite rapidly still, because it doesn't, like, even if like a lot of companies fired and projects fired a bunch of people, I mean, in my experience, you don't always need like, a few thousand people to build something. You're actually better off with fewer people. You can move faster and build things uh, quicker for sure, and sometimes also better. So yeah, I'm really bullish on the current kind of landscape and situation, and a lot of venture capital still flowing into the space. Even if AI is kind of running it, the way it's doing in parallel, it doesn't really matter. There's so much going on in the blockchain space anyway. So, it's definitely not a lack of capital.
Agreed. I would say I'm not that much concerned about the technology side of things. I'd say that most challenges we're experiencing now is firstly operational, that is getting this technology to fit into the existing complexity of capital markets and legislation, and B is marketing, is getting adoption. So I would say companies that are really good at education, at getting people excited and making good consumer level stuff are going to be, even if they won't be the main winners in terms of capturing the value and the margins, in terms of actually bringing the market to happen, they would be one of the most important aspects of ecosystem.
Yep.
Okay.
Absolutely.
Mm-hmm. Okay.
Well, good to have a proper talk through of various aspects of
Mm-hmm.
pros and cons of what we're doing. As I enjoyed it, and I hope some of the listeners did too. And I'm looking forward to chatting again and having a follow up in a few months' time to see where we are.
Likewise, greatly appreciated the discussion. Thank you for joining and for giving your excellent points. And I'm fully on board with having a follow-up chat in a few months. So definitely let's keep in touch.
Awesome. Okay. Thanks, Boris.
Thank you. Wish everybody a great time of the day. See you.
Alrighty. See you.